Welcome to Matt and Mike's Market and Mortgage Minute, which is tricky as hell to say, but this is going to be our first of a series of videos for you guys to watch, enjoy, where we can talk a little bit about what's going on with the market or answer some questions for you guys. So that's what we're here to do. Mike, why don't you start us up?
Absolutely. Yeah, just bring a little bit of fresh information to everybody and let you know what's going on out there. Big thing that's been in the news lately, there were a couple banks that had some troubles. Matt, can you talk a little bit about that and what that may mean for people that are looking to buy and sell houses?
Sure. So, I mean, the biggest, just to kind of catch everybody up if you'd missed it in the news, and if you did, how could you? But if you didn't catch it, about 3 weeks ago, Silicon Valley Bank pretty much imploded, I guess is the best way to put that. And it's caused a lot of turmoil in the industry. And basically, they were poorly invested in a lot of different things, whether they were doing bad in their treasury market, bond trading, or investing in some Silicon Valley startups in crypto that didn't really work out. Now, the biggest thing to know from this, which has actually made the market more sure, is the fact that the federal government stepped in immediately and covered all the deposits. They didn't let there be a bank run. They didn't make it a complete implosion. And so that stopped a lot of what would have been a cascading effect on this. Now, there was other banks that were related to them, that banks loan each other money. So there was still effects on this, but it could have been a lot worse.
Okay, that makes sense. So it wasn't really something tied to mortgages or anything like that. We're not seeing a bunch of people defaulting on their loans or anything like that, a rise in foreclosures from something like that that could create mayhem in the marketplace.
Yeah, see, that's the biggest difference between what's going on right now versus, anybody who lived through the traumatic experience of 2007. I know the scars run deep. I'm still dealing with them in my therapy, but, the difference is the fact that that was solely based around mortgages. That was a matter of people had 2-year fixed loans instead of 30-year fixed loans. And when they came up for adjustment from 6%, then they jumped all the way. Back then it was 6%, 6.25%, just like now. They jumped all the way to 9 and 11% interest rates. And of course, at that point, the borrower couldn't afford it anymore. So they defaulted. Then the insurance companies also couldn't, they weren't getting paid back. The mortgage companies weren't getting paid back. And a lot of those were tied up also in what's called mortgage-backed securities. So the investment firms were collapsing as well. So all that surrounded was the mortgage company. What is going on right now has nothing to do with mortgages at all. And if anything, the funny part about the whole thing is it's actually kind of good for mortgages, if that makes any sense. And I know to hate to be this guy, like Wednesday Addams on the Addams Family, but, I've been accused of being a little depressive at times because when things go bad, that's actually good for mortgages. That's, the reason rates were at 2.5% during the pandemic was not because we were all sitting on the beach having a nice time. Rates were at right. 2.5% during the pandemic because we were all sitting at home, maybe drinking a little too much. The low interest rate is a way to stimulate the economy when the economy is doing poorly. High interest rates are designed to slow down the economy when it's overheating with inflation and things like that. What's going on with these banks having problems actually could be something, and we've seen a little bit of this, lowering the rate a little bit, because all of a sudden the Federal Reserve is sitting there looking at it going, uh-oh, this is going to be a problem, because, they have more things than just mortgages on their mind. They have the larger economy to think about, and they're going, okay, could this play into other industries, other part of the economy, and therefore maybe we need to pump the brakes on raising interest rates.
I think we've seen that a couple times. Have Fed to a little bit of this over the past couple months, and recently I think he just said that they went up. They decided to raise rates 0.25%, right. Or 1/4 point. So yeah, I think we've seen a little bit of that over the past few months anyway, where they've reacted to some of the changes and tried to control, and all of the efforts to control inflation.
Yeah.
I'm not one to say if they're being successful or not. Do you have anything you want to put in on that?
Yeah, I mean, well, first I'm going to give you a little tip. 1% and 1 point are the same thing.
Okay.
So a 1/4 of a point and 1/4 of a percent, right? Other also expresses 100 basis points. There's a couple different ways to slice it, but I just wanted to, that's a tip. So if you're ever hearing that word out there, you can look at it and say it's all the same thing. I mean, so what we all got to realize, and we started seeing this back in December, that rates were going down. They had gone down from basically Thanksgiving all the way until after New Year's. But then the data started coming down, and that was when we were starting to see inflation actually relax for a minute and not be as aggressively going up. What the problem is, what we're seeing since middle of January and on, is it's come back with, how to put it this way. Everybody for a minute stopped spending so much, and then everybody went, oh, well, I'm not spending that much, so let me go ahead and start spending some more. And so since, January to February into March, before all this happened, the Federal Reserve said, oh, God, we thought everybody was relaxing and holding on to money for 5 minutes, and now they're back spending again. All right, we got to raise it again. Initially, they were talking about a 0.5 point raise come, the last Fed meeting about 2 weeks ago. But with them actually seeing what's going on with these other companies out there, other banks, other institutions, First Republic was another bank that's having a lot of problems right now. They've all of a sudden said, oh, okay, let's just do a 0.25 point. We still got to keep inflation under control, but we don't need to be as aggressive with it. And that initially, the concerns on that initially had rates going up a little bit. Now, actually, we're going back down a little bit. Believe it or not, Mike, I priced something up at 6.75% on an FHA 3.5% down payment assistance program today. And that's a pretty good rate for down payment assistance. So we are seeing actually some relaxing, and the sky's not falling.
That's all really, really good news. In general, I know that rates are higher today than they were last year. And of course, in times prior. Where are we overall? I know that the competition has slowed in the marketplace a little bit. There's so little on the market for people to be able to buy. So that's keeping the house prices up. But rates also tie into that as well, to what is actually able to afford. And of course, as the rates move up or down, somebody's affordability changes a little bit. And that's been one of the things that has kept the buyers a little more conservative in their ability. So what do you see going on with rates right now? Everybody talks about a return to normal. Is that what you see?
Well, it depends on what you define as normal. Is there such thing as a normal rate? Let's start there. My personal lifetime experience, I go normal somewhere around 4s and 5s. That's kind of, to me, not a good economy, not a bad economy, a kind of medium-paced economy. That's where we were circa 2016, 2017, 2018. So that's why I kind of think about that as normal, because it wasn't good or bad. As for whether or not we're going back to that, I mean, inevitably we will. It's kind of, as we talk many times, like the market goes up, the market comes down. The market goes up, it comes down. It's sooner or later, and even like look at the 1970s oil crisis and inflation during that, nothing lasts forever. Eventually it does get under control and it is worked out. So I don't think that's going to be the thing. It's just a question of when. I mean, I still, with kind of some of the news that's coming out, could see late this year, early next year, us getting back at least into the 5s. Obviously, if I knew it for sure, I'd be a millionaire. So I don't. But I go to the biggest problem is not, how to put it this way, because there's so many different ways we can skin the cat depending on what the situation is with somebody. Whether that's giving them down payment assistance or believe it or not, okay, here's an example of something. We had a borrower qualified for 85% DTI on a VA loan. We've had 56 and 57% DTIs on FHA loans. So there are ways to find, ways to get it done, even with higher rates. Now, is that lower than what it would be if it was 2% or, 2.5% on a 30-year fix? Of course. Yeah. You qualify for less, but I don't think it's such night and day. And I don't think it's an issue of the buyers. There are buyers out there left and right. I mean, I can't tell you how many pre-approvals we are sitting on going, okay, is today the day that their offer gets accepted and we got a contract going? It's if anything, they're piling up of the number of people. And if anybody ever wants a list and wants to know, hey, I got somebody for $250, I got somebody for $300, You got a property for this? I got a buyer for you in 5 seconds who's ready to go. Please let me know. Email me. It's a good and bad problem to have. I think the biggest issue is the number of properties that are on the market right now. That's I think that's more jamming up where people being busy are, the lack of inventory over, hey, these rates are so high, borrowers don't qualify.
Understand that. I mean, we've talked about it on some of our managers' calls that the amount of inventory that's available that could be lived in today, if you go from Martinsburg to Harrisonburg, there's a total number of houses available that's lower than what we carry as a company. So there's definitely not very much out there. Of course, the only fix to that is to make more dwellings, and that's a long-term solution. I mean, you can't exactly squeeze a house out in 2 weeks. So it takes a little bit of time to fix that. You mentioned down payment assistance a little bit. That'd be a lever that we can pull for some people to let them move forward with the opportunity. You want to talk a little bit about that? That's an interesting one.
Yeah. So again, and this is it's so funny, and I don't know why these trends happen. So 2 years ago, every mother and their brother had 20% down and 800 FICO score ready to go when the rates were at 2.5%. Now that rates are higher, and with inflation and the cost of goods and everything like that going up, people don't have as much money in their pocket, but it doesn't mean they still can't buy a house. So we actually just rolled out a brand new down payment assistance program that will actually give the borrower up to 6% for either, and you can kind of do it a couple different ways. You could do 3.5 down and then take 2.5 to cover your closing costs. You can actually put a whole 6% down and then cover your closing costs yourself. It really does, depends on how you want to move that around. It has other options and different price points because the less you're asking for, the better rate you get. Because rate reflects risk. So you're asking for 3.5 down, that's a better rate than if you're asking for 6 down. So be advised of that. But the purpose is, hey, you can get it either way. We'll just have to figure out what's the best optimal situation. And what's kind of even cooler about these programs is there are no income restrictions. I know a lot of the state and federal programs out there, if you make more than the median income of the area, sorry, you're out. And maybe you just happen to be in a high cost area. So of course you make that much money, but doesn't mean you're able to put aside, whatever amount a month to save up for a down payment. You got 4 kids, something, who knows what your situation is, but there's a reason.
Right.
Because of this not having any income restrictions, I can tell you right now, I have a borrower who has makes $130,000 a year, but just can't afford to put aside any money with kids and everything, single mom. And so they don't factor that in. They don't go, oh, you're a single mother, we're going to cut you a break. That's not a problem. She's getting down payment assistance. So we're helping out with that, even though she makes a really, really good income. I will advise you this. Go ahead.
I was going to say, so it's not necessarily just income or credit challenged people. It can be any number of situations or scenarios.
Yeah. I mean, and this is a great opportunity for our agents to talk to, because in the respects of there's so many renters out there. If anything, I would have to say there's, from my understanding, the word on the street is there's overqualified renters. We have people that we would typically see moving into houses with 800 FICO scores and saved up the first month's, last month and deposit, renting. Why? Well, because maybe they got first month's and last month's, but they don't have the down payment. Well, great. Let's take that part out of the equation. They have basically what would be the closing costs, and if we need to give them a little extra for that, we can do that too. So that's where I'm just going. We have overqualified renters who are paying higher than ever rent when they don't need to.
Well, of course, they're going to continue to go up because it's a number of places for people to live. And so, you say it all the time that you can get your mortgage dialed in and you can keep that in a place you can count on it, but rent can go up at.
Nope. Mike, I lost you there for a sec. I don't know if you can hear me. Oh, sorry, I lost you.
Yep.
What was that? Okay. I missed that last thing about the rent.
I was saying, you say it all the time that rents can go up arbitrarily, but you can get your mortgage locked in and know what you have to expect each month. and you're working on paying your own mortgage instead of somebody else's. So these programs sound great for the right people that we can use it to help some people.
Yeah, and I look at it in this respect again. I know we're all a little rate sensitive here or there, but whether the rate is 7%, the rate is 8%, even if rates went to 10%, whatever that number is, you never have to change that again for the next 30 years of your life. Now, if it goes down, if we get back to the 4s, the 5s, the 3s, great, refinance and save yourself some money. But you are now living whatever you lock yourself in for 30 years, you're living your worst case scenario ever. Versus if you're renting from somebody, again, landlord wants up the rate. Maybe the landlord wants to sell the property, you're at his wins. When you're owning a home, you're in the driver's seat and you've capped yourself at your worst case scenario for the rest of your life. Not, your neighbor buys a house a year from then, and not like, I can't imagine why there's not violence in neighborhoods right now between the people who got their loans at 2.5% and the new neighbors moving in at 7%, just giving them like the dirty eye from across the lawn, just going, I hate you so much right now. Right. Nevertheless, it's not happening. But you, like I said, you locked yourself in, you're never going any higher. And that's a good thing that you can kind of plan a little better for the future. And it's, smart way to be.
Absolutely. That makes sense to me. So as we wrap up, Matt, what are some of the conversations you think that we need to be having? What do you think the conversations that loan officers and agents be having with people out there? Is there anything on top of your mind?
I mean, the biggest thing is, again, people don't know what they can do until you take a look at what you can do. It doesn't hurt to look. What is the worst case scenario here? If in the respects that if somebody was to say, okay, Matt, actually I had a borrower, we've been talking on and off for 3 months. She came to me and she didn't have the greatest credit. She's telling me how, okay, well, I signed up for a couple different apps that help you manage, paying down these things that were in collections. I've been working on that. I actually was able to check it the other day. I'm up in the high 5s right now. And I'm going, okay, if we get a little bit higher, then we're going to be really in the good zone to start talking about what we can do. It's a conversation. And the sooner we start having that conversation, the better. So it shouldn't be hesitant about what's going on with the market. Because like I said, the worst case scenario, you're capping yourself. It's getting out there and still, going back to the basics, if anything, and going back to, I used to work open houses all the time with my agents. I used to go door knocking with agents at time. Getting back to that point where you're getting out in front of people and really putting it out there that it's still possible, that you don't need to have this doom and gloom. Oh my gosh, the sky is falling and blah, blah, blah. Because I guarantee there is a place you come into a conversation with the sky is falling and your borrower will be a mirror of you. Your buyer or seller will be a mirror of you. And therefore they're going to go, oh my God, you seem depressed and unhappy. I guess I should be depressed and unhappy. And it's going, no.
Buying a house sucks.
Right. Buying a house, selling a house, it all sucks, and I don't want to do it. You know what? Forget it. I'm just going to stay here till I die. It's having that proper way of looking at the market, and that comes through knowing what's going on and kind of realizing that people like to get overhyped. I'll just put it to you that way. One bad thing happens, and I know it's been a rough year at times, but it's going, you can't just run off the deep end just because this happened. You have to go, well, what really did happen? Again, like we were saying earlier, the default rate is not up. People are not defaulting on their mortgages. So if they're not defaulting on their mortgages, we're not going to have a whole bunch of people in foreclosure and causing bank problems and all this other stuff. So it's not just because this looks a little bit like, that doesn't mean there's the same things. Yes, they both involve banks. That's the only similarity I can give you.
I think that's a really important point. Because in this, we've talked about lenders have tightened restrictions, and that's kind of the theme through the market over the past 2 or 3 years, that it is a lot more difficult to qualify for a mortgage today than it was 10 or 15 years ago. So that's a protection. The default rate, you said, is down, so people aren't defaulting their mortgages. Okay, so people are getting mortgages and they're paying them. That's a thing. So really, that's a lot of stability. in the marketplace. And there's another number that we hear out there all the time, that people have more equity in their properties now than they really ever had historically. So all of that shows signs that a crash isn't tomorrow. Like you said, it's not 2008 again, and it's all going to be okay. We just need to be positioned to help people accomplish whatever they have thrown at them. Death, divorce, injury, inheritance, family change, job change, all those things still happen that we're going to be dealing with. And we just need to be able to be the voice of reason and assure people that, look, you're going to get through this okay. You know, yeah, you can't get a 2% interest rate, but we can help you get through this, and it's going to be just fine and land you where you need to be.
Right. And I think that's a huge, I actually will leave with this thought. If you want to still do business and get business, having that kind of education and knowledge about what is going on when other agents are running around like their hair is on fire, screaming, the end of the world is nigh. And you're going, actually, no, look, the default rate's actually getting less, not more. Less people are defaulting, not more. Hey, this is an isolated incident based around this, not about housing. You sound educated, you sound smart. You're going, hey, I know what's going on, and look at me, I'm not panicking, versus the agent who doesn't understand any of this. So of course it's scary. I was a kid once, and I hated going to Disneyland because I hated the dark, because I didn't know what was going on at the Haunted Mansion. It's the same thing. You don't know what's going on, it's scary. But if you know, these are puppets and it's animatronic, then you're like, oh, that's not scary. That's not scary at all. So it's really about educating yourself, and that's kind of why we decided to start doing these videos, so we can have these conversations and kind of keep everybody in the loop on where things are going.
Absolutely. Yeah. And I think this was a good one. I don't know if you've got anything you want to say as a parting thought, but I think really what we're trying to accomplish is help you be more confident and help you understand what's going out there, and maybe share a little bit about what we think about things. So I hope this was helpful. Matt, you got anything you want to say in closing?
No, I'm just really appreciate it. I agree. I had a good time here, and I think we're going to be doing a lot more fun videos like this in the future.
Awesome. Sounds good. Looking forward to it. Hope everybody enjoys you. Take care. We'll talk soon.
Thanks. Bye.